Can you time the stock market? That's implicitly the question we ask ourselves anytime the market is flashing red. And in this video, I'll show you how to test your stock market timing ability in just a few minutes using a free simulator. And then we'll discuss why sitting on your hands is usually the best and simplest way to manage your investment portfolio. But remember, simple does not mean easy. For example, if you want a good night's sleep, don't eat greasy chicken wings right before bed. Simple, but why do I keep on doing that? Hey everyone, my name is Preet and this channel is for anyone who wants to learn more about personal finance, investing, and the world of money around us. If you are like most people, when stock market losses are in the news, you wonder if you should be doing something. Even though you may have seen all the charts that show you that the stock market zigs and zags all the time, and in retrospect, simply holding on and ignoring the dips, corrections, and crashes eventually rewarded people who just held tight. It's so simple. And then you invest and everything changes. Those theories that made so much sense seem out of touch because this time it's different. Arguably the four most dangerous words in investing, because just hearing them makes you think, yeah, maybe what the theory says and what worked in the past isn't the way to go. Maybe we do need to make a change. Let's introduce a concept known as action bias. Action bias is the tendency to favor doing something instead of doing nothing. Where this can be problematic is when we have this desire to do something even though there is no sound reasoning as to why this action would be expected to be beneficial. This may sound like a tangent, but it's not. In an older paper published in 2007, researchers examined the behavior of professional football goalkeepers, or soccer goalies if you're American, during penalty kick situations. And they analyzed the probability distribution of kick direction and found that the optimal strategy to stop the most goals would be to just stand there and do nothing. However, the goalkeepers dove to the left or the right like 94% of the time. And if you've watched a penalty shootout, it's common to see a goalkeeper dive in the wrong direction to the kick because the reaction times needed to wait and see where the ball is going before making a decision to act are just too fast for the human body. But just imagine if a goalkeeper just stood there on every single kick and did nothing. If they let in a goal when they chose to do nothing, it would feel way worse than diving in the wrong direction and letting in that same goal. And depending on what country you play for, your fans may be more likely to shoot you. The comparison is clear. We have seen time and time again the headlines about stock market losses that trigger us into wanting to do something. Once that doubt has been injected into our minds, we now think, well, if the market does end up continuing to go down and ends up crashing, I'd beat myself up for not doing something about it. But here's where it gets even trickier. If you sell, you then have to figure out when to get back in. To be a successful market timer, you not only have to be right about direction and timing, you then have to do that one more time. Here's a hypothetical situation. You started with $100,000 in the market and you're up 20% to $120,000. Then the market has a 10% correction. You think the market is going to crash soon, so you sell. The market goes down another 5% and you think, nope, I won't get back in until the crash really happens. So you stay on the sidelines. In the meantime, a diversified portfolio is throwing out dividends that you're missing and bouncing around, and it never actually gets to crash territory. It was sideways for maybe a year and then starts taking off again. You miss out on 20% of gains and then you buy back in. And then the market drops 10%. You were right all along, and you sell again because you think that the other shoe is finally going to drop and a big crash is coming. Except it doesn't. It bounces right back up and continues to earn another 40% over the next 5 years. The value of your portfolio, had you just sat on your hands the entire time, instead of second guessing yourself repeatedly, cost you over $50,000. In fact, you're showing a loss while the market was up a cumulative 55%. So how hard is it to be a successful market timer? Well, you can find out the hard way or the easy way. The hard way is to try it with your hard-earned money. But an easy way is to play a market timing simulator. There are two you can try, and the first one I'll call the easy mode. It tests if you can successfully call a drop and then get back in just one time. So you can sell once and then buy to get back in once, and then see how that one market timing cycle would have impacted your portfolio's performance. This simulator uses actual returns from the S&P 500 picked from a random point in time. You don't know what time period you're looking at until the simulator finishes the simulation, but then you see just how well or poorly you did. And if you try this one out, I would love if you could enter your results in the comments down below. And don't cherry pick your best result. Either give us your first result or tell us how many times you won or lost if you play multiple times. But for those of you who want to take it up a notch, our next simulator allows you to buy and sell multiple times. And you're again given actual stock market past performance from a randomly selected 3-year period going back as far as 1950. But you can adjust the speed of the simulation, you can extend the game after the first trial, and more. You can see the value of your portfolio is flat when you are out of the market, and you can get a tease as to what your emotional reaction is to seeing the market moving while you are on the sidelines, as well as when you have skin in the game. What's interesting is that after the first 3-year period ends, you'll be told what period of data you've been looking at. So in theory, you're given more help for successive extensions of the same simulation. But I'll bet even with the extra knowledge, you'll find simply staying invested was often the better and simpler strategy. Again, share your results in the comments and you can find links to both simulators in the video description. So while we might see how a simple buy and hold strategy might make the most sense for most people, it's still hard. So how can we make it a little easier? Well, one way is to make sure that we have the right perspective. When we see the headlines talking about losses on the Dow or the S&P 500 or any other stock market index, remember, those are 100% equity portfolios. You might be in a more balanced portfolio with an asset allocation of 60-40 and with diversification in your equities into more than just one stock market. Let's take a quick look at how exactly a portfolio that might be more matched to your risk profile, like a balanced portfolio might be, would perform during market stress versus an all-equity portfolio. And because some investors might be tempted to tilt towards growth stocks during long bull markets, I'll use an S&P 500 growth index and then compare that to a balanced portfolio. If we look at the tech bubble and burst, we see that our all-equity portfolio had a great compounded annualized growth rate of 9.66% between 1995 and 2015. Amazing, but not so fast. Few people would have held on to get those returns. Let's look at a drawdown analysis to see just how nasty it could have been. What's particularly nasty is that the maximum drawdown during the tech bubble bursting was over 50% for this portfolio. But the total amount of time underwater, meaning the total amount of time it took to recover the losses incurred, was 12 years and 5 months. Imagine waiting over a decade before getting back to break even. That would test the mettle of even the most convicted investor. But what if we pick a balanced portfolio with a 60-40 equity to fixed income mix, with 40% in broad US stocks, 20% in international stocks, and 40% in US bonds? The first thing we'll note is that the long-term annualized return was less at 7.54%. But let's look at the drawdowns. Visually, we already see a big difference. The maximum drawdown during the dot-com bust was around 20% instead of over 50%. And perhaps more importantly, the underwater period was only 3 years and 4 months. So while the long-term return of the portfolio was lower, you would be more likely to stick with it through thick and thin than the all-equity portfolio, and less likely to be tempted to second-guess yourself. And we saw how trying to time the market can lead to lower returns. If those lower returns also came with more stress, then you can see how a balanced portfolio that is easier to stick to can actually lead to a higher portfolio balance, even though the potential performance is lower than a more aggressive portfolio. There's a very famous saying in investing: think of your portfolio like a bar of soap. The more you touch it, the smaller it gets. In an upcoming video, we'll look at another great perspective and technique to help you increase the likelihood of success with sticking to your investment strategy. So don't forget to subscribe to my channel because that will be coming soon. Don't forget to visit the market timing simulators and leave a comment below with your results. And no cherry picking. And if you like this video, I hope you'll hit that like button and subscribe to my channel to learn more about money and managing your finances. And of course, hit the bell to turn on notifications for when I publish new content. And I will see you in the next video.